Welcome back to Simple Minds Space, your go-to podcast for unlocking your financial potential. Today, we're diving deep into the world of real estate investing, specifically focusing on rental properties. And let me tell you, while it's a proven path to wealth, it's not for the faint of heart. Before we get started, I want to be upfront. This isn't some get-rich-quick scheme. It takes work, dedication, and a bit of a strategic mind. But if you're willing to put in the effort, the rewards can be life-changing. I'm talking about building long-term wealth and securing your financial future. Think of it like this. You buy a property, find responsible tenants, and they essentially pay off your mortgage for you each month. Meanwhile, your property is steadily appreciating in value, like a silent money-making machine working in the background. By the time you're ready to retire, you've got this incredible asset, often completely debt-free. Let me break down the math for you, because seeing is believing. Imagine you have $30,000 to invest. You could put it in the stock market, hoping for decent returns, or you could use it as a down payment on a $300,000 rental property. Let's assume you snag a 30-year fixed mortgage at a 4% interest rate. Your monthly mortgage payment, including principal and interest, would be around $289. Add in property taxes of $400 and insurance of $250, and you're looking at roughly $1,939 in monthly expenses. Now, find yourself some reliable tenants willing to pay that amount or more in rent. And guess what? They're covering your costs while you build equity. Here's where the magic of leverage kicks in. Your initial investment was only $30,000, but the entire $300,000 property appreciates in value, not just your down payment. Historically, real estate appreciates between 3 to 5% annually. Let's go with a conservative 4%. That means in 30 years, your $300,000 property could be worth a whopping $973,000. You've essentially turned your initial $30,000 into almost $1 million. Now, I know what you're thinking. What about inflation? Won't that eat away at my profits 30 years down the line? Here's a different perspective. Owning a rental property can be your shield against inflation. In today's uncertain economic climate, who knows what the future holds? Inflation could soar, home prices could skyrocket, but at the end of the day, you'll own a valuable asset free and clear. Think about the peace of mind that comes with owning an additional property outright. No mortgage payments, no landlord headaches, just pure financial security, no matter how crazy the economy gets. That's the power of real estate. Now, let's be realistic. The stock market might offer seemingly higher returns in the short term. Invest your $30,000 there, and with a generous 10% annual return, and let's assume no taxes for simplicity, you'd have around $523,500 after 30 years. It's a great return, but it pales in comparison to the potential of real estate leverage. But here's the catch with real estate. It's not without its challenges. Bad tenants, unexpected repairs, market fluctuations, they're all part of the game. That's why I'm going to share 10 crucial tips based on my own experiences, mistakes, and hard-won lessons. These tips will save you money, stress, and potential headaches down the road. Tip number 1, protect yourself with an LLC. This is non-negotiable, people. An LLC, or limited liability company, provides a legal barrier between your personal assets and your rental property business. Imagine a worst-case scenario. A freak accident on your property leads to a lawsuit. Without an LLC, your personal savings, investments, even your primary residence could be at risk. An LLC helps protect you from personal liability. Setting up an LLC is crucial, and it's essential to do it correctly. If you're renting out your current home, you'll need to transfer the deed to your LLC. If you have a mortgage, it's always wise to get written consent from your lender before transferring the property. While most lenders are understanding, as long as mortgage payments are maintained, it's better to be safe than sorry. Consult with a real estate attorney to ensure everything is done by the book. It's a small investment for significant protection. Tip number 2, secure landlord insurance. While requiring renter's insurance from your tenants is smart, it's not enough. Landlord insurance provides an extra layer of protection, specifically for property owners. Think of it as your first line of defense against liability claims, property damage, and lost rental income. Landlord insurance works in conjunction with your LLC. If a covered event occurs and you're sued for an amount exceeding your policy limits, your LLC helps shield your personal assets from further liability. Tip number 3, thorough tenant screening is key. Finding good tenants is the linchpin of successful real estate investing. A bad tenant can lead to missed rent payments, property damage, and endless stress. Trust me, I've been there. Always conduct thorough background and credit checks. You'll need your potential tenant's consent, but this is standard procedure. These checks help you filter out red flags and choose tenants who are responsible and financially stable. Remember, this is a business decision, not a popularity contest. Tip number 4, handling tenants effectively or hire it out. Dealing with tenants directly can be time-consuming and emotionally draining. If you're not cut out for it, consider hiring a property management company. They'll take care of everything: finding and screening tenants, collecting rent, handling maintenance requests, and even dealing with evictions if necessary. Property management fees vary depending on your location and the services you require. Ask for referrals from your real estate agent or network and check online reviews. Just ensure the fees align with your budget and the potential rental income. Tip number 5, act swiftly with problematic tenants. If a tenant misses rent payments, address the issue immediately. Don't let it slide, hoping it will magically resolve itself. It won't. You might need to involve legal professionals to protect your rights as a landlord. Having a clear lease agreement outlining late fees and consequences for non-payment is crucial. Document all communication and actions taken to create a paper trail should you need to pursue legal action. Tip number 6, navigate security deposit laws. Security deposit laws vary significantly by location. Some cities have strict regulations on how much you can collect, how it must be held, and under what circumstances it can be used. Failure to comply can result in hefty fines. Research your local laws or consult with a real estate professional to ensure you're handling security deposits correctly. In some areas, landlords opt for non-refundable move-in, move-out fees to avoid the complexities of security deposit regulations. Tip number 7, the hunt for a good deal is crucial. You can't just buy any property and expect it to be a cash cow. Finding a good deal is essential for profitability. Before making an offer, analyze the numbers meticulously. Calculate your monthly expenses, including mortgage payments, property taxes, insurance, potential maintenance costs, and HOA fees, if applicable. Then, research comparable rental rates in the area to determine if you can charge enough rent to cover your expenses and generate positive cash flow. Don't forget to factor in potential vacancies and the cost of turning over the property between tenants. Tip number 8, credit score is your best friend. A good credit score is your golden ticket to securing favorable loan terms and lower interest rates. Lenders view borrowers with good credit as less risky, meaning they're more likely to offer competitive rates and terms. Work on improving your credit score before applying for a mortgage. Pay your bills on time, reduce your credit utilization ratio, and avoid opening unnecessary new credit accounts. Tip number 9, don't fear rental property taxes. The tax implications of owning a rental property often scare away potential investors. But let me tell you, it's not as daunting as it seems. First, reporting rental income on your tax return is relatively straightforward, especially with tax software or the help of a tax professional. Second, the tax deductions associated with owning a rental property can significantly offset your rental income, potentially resulting in little to no tax liability. You can deduct mortgage interest, property taxes, insurance, repairs, maintenance, property management fees, and even depreciation. Depreciation is a significant tax advantage. The IRS allows you to deduct a portion of the property's value each year to account for wear and tear, even if the property is appreciating. It's a fantastic tax break that can save you thousands of dollars over the life of the property. Tip number 10, strategic tax planning for selling. When it comes time to sell your rental property, there are strategies to minimize or even eliminate capital gains taxes. One option is a 1031 exchange, which allows you to defer capital gains taxes by reinvesting the proceeds from the sale into another like-kind property. Another strategy is to hold onto the property until death. At that point, your heirs inherit the property at its current market value, effectively stepping up the cost basis and potentially eliminating capital gains taxes altogether. In a nutshell, we've covered a lot of ground today, from the fundamentals of real estate investing to the importance of tenant screening and tax advantages. Remember, real estate investing is a marathon, not a sprint. It requires patience, diligence, and a willingness to learn and adapt. If this sounds overwhelming, that's okay. There are alternative investment avenues like retirement accounts, index funds, and REITs. But if you're ready to build long-term wealth and secure your financial future, real estate investing might be your path to success. I hope you found this deep dive into the world of real estate investing helpful. If you enjoyed this episode, please show your support by liking, subscribing, and sharing it with anyone who might benefit from this information. Until next time, keep those financial goals in sight, and remember, financial freedom is within your reach.